If I asked you one simple question, where is your money right now? Most people would answer, my bank. Seems obvious. After all, you open the app, you see your balance, you use the debit card, your paycheck arrives every 2 weeks. Everything works exactly the way a bank should. So why would you ever question it? But here's something that shocked millions of Americans. The logo on your banking app might not belong to the company actually holding your money. And in some cases, that app isn't a bank at all. Now, before you think this only happens with small startup companies, it doesn't. Over the last decade, millions of Americans have moved away from traditional banks and into sleek financial apps that promise faster transfers, no monthly fees, early direct deposit, and higher interest rates. They look modern, they feel trustworthy, and for years, everything worked perfectly. Until one day, it didn't. In 2024, thousands of Americans suddenly found themselves locked out of their own money. Their balances were still showing on the screen, but they couldn't transfer it, they couldn't withdraw it. Some debit cards stopped working, automatic payments failed. For many families, it happened without warning. Naturally, people assumed the bank had collapsed, but the bank hadn't failed. There wasn't a massive cyber attack, and their money hadn't simply vanished. Instead, the problem came from a company almost nobody had ever heard of. A company working quietly behind the scenes, hidden between banking apps and the real banks that actually held customer deposits. That invisible company was called Synapse. Before 2024, most Americans had never heard that name. After its collapse, it became one of the biggest warnings the fintech industry had ever seen. Because for the first time, millions of people realized something they had never stopped to ask. Who actually has my money? Is it the app on my phone, the companies whose logo I see every day, or someone else entirely? The answer is far more complicated than most people imagine. And once you understand how this hidden banking system really works, you'll never look at your banking app the same way again. Because this story isn't just about one company going bankrupt. It's about how modern banking quietly changed while almost nobody was paying attention. And if you use digital banking, whether it's Chime, Current, Cash App, or dozens of other financial apps, what you're about to learn could completely change the way you think about where your money actually lives.
So, how could something like this even happen? The answer begins with a simple misunderstanding. Most people think when they deposit money into a banking app, that company is holding their money. But in many cases, it isn't. Let's say you download a new financial app. Creating an account takes less than 5 minutes. You get a debit card, a routing number, direct deposit, instant transfers. Everything feels exactly like opening an account at Chase or Bank of America. So naturally, you believe, this is my bank. But behind the scenes, something completely different is happening. The app you're using often isn't a bank at all. It's a technology company. Its job isn't to hold your money. Its job is to create a beautiful app, make banking feel simple, and attract customers. The actual money usually sits inside a completely different institution, an FDIC-insured partner bank. Think of it like ordering dinner through Uber Eats. You place the order in one app, the food is cooked by someone else, and it's delivered by another company. You're interacting with one brand, but several different businesses are working together behind the scenes. Modern digital banking works in a surprisingly similar way. Your banking app is simply the front door. Behind that front door, there's an entire system most customers never see. The app, a technology platform, a partner bank, payment networks, and other financial infrastructure. As long as every piece works perfectly, you'll never notice it exists. Your paycheck arrives, your card works, your balance updates instantly. Life feels normal. And that's exactly why millions of Americans never questioned it. Why would they? Everything looked and felt like a normal bank. But here's the part almost nobody talks about. Every additional company in that chain creates another point where something can go wrong. If one company has a technical failure, transactions can slow down. If another company has accounting problems, payments can be delayed. And if the company connecting everyone suddenly disappears, the entire system can become incredibly difficult to untangle. That's exactly why experts often compare modern fintech to an ecosystem, not a single company. Because your money may pass through multiple businesses before it reaches the bank that's actually holding your deposits. For years, this system helped make banking faster, cheaper, and more convenient. It allowed financial apps to grow incredibly quickly without becoming full-scale banks themselves. By 2024, millions of Americans were using fintech apps every day. Many people trusted them with their salaries, emergency funds, and everyday spending. Everything seemed to be working exactly as promised. Until one company, sitting quietly in the middle of that entire system, collapsed. A company that most customers had never heard of. A company called Synapse. Its name wasn't printed on debit cards. It wasn't displayed on home screens. Most users had no idea it even existed. But when Synapse filed for bankruptcy, the hidden system behind modern banking suddenly became visible. And for thousands of Americans, it exposed a question nobody expected to ask. If the bank didn't fail, then why can't I get my money? The answer would reveal just how complicated modern banking had quietly become.
For years, nobody thought much about Synapse. In fact, most customers had never even heard the name. And honestly, they weren't supposed to. Synapse wasn't a consumer brand. It didn't advertise on television. It didn't offer checking accounts. It simply operated behind the scenes, helping financial apps connect to real banks. As long as everything worked, nobody noticed. But in April 2024, everything changed. Synapse filed for bankruptcy. At first, it sounded like just another tech company shutting down, the kind of business story most people scroll past without thinking twice. But within days, customers started reporting something strange. Their banking apps still opened normally. Their balances were still visible. But when they tried to move their money, nothing happened. Transfers failed. Debit cards were declined. Automatic payments stopped going through. Some people couldn't pay rent. Others couldn't buy groceries. And for many, it was the first time they realized their app wasn't actually controlling their money. One of the companies caught in the middle was Yada. Yada had built its reputation around making saving money feel fun. Thousands of Americans trusted it with their everyday finances. Then, suddenly, many users couldn't access the money they believed was safely sitting in their accounts. Imagine checking your balance, seeing thousands of dollars, and still being unable to pay for dinner. That's exactly what some customers experienced. The shocking part? The money hadn't simply disappeared. The problem was that the companies involved were trying to figure out whose records were correct. Think of it like four people trying to keep score during the same game. If every scoreboard shows a different number, nobody knows which one is right. Until those numbers match, everything stops. That's essentially what happened. The banks had records. The Fintech apps had records. Other companies in the middle had records. But when those records didn't line up, customers were left waiting. Some waited weeks. Some waited months. And while courts, banks, and companies worked to sort everything out, ordinary people were the ones living with the consequences. This is also where one of the biggest myths about modern banking became obvious. You've probably seen the phrase, FDIC insured. Most people hear those words and assume my money is protected no matter what. But that's not exactly how it works.
FDIC insurance is designed to protect eligible deposits if an insured bank fails. In the Synapse case, the partner banks themselves generally didn't fail. The failure happened inside the technology connecting everyone together. That's why the situation became so complicated. For customers, everything looked like one company, but behind the scenes, it was actually several different companies working together. When one piece of that system broke, nobody could fix it overnight. And that's the biggest lesson from this entire story. The biggest risk wasn't that people trusted technology. The biggest risk was trusting a system they didn't understand. Because when everything works, every banking app feels exactly like a bank. It's only when something goes wrong that you discover who was really responsible all along.
So, does this mean every fintech app is dangerous? Absolutely not. In fact, millions of Americans use digital banking apps every single day without any problems. Apps like Chime, Current, SoFi, and many others have helped people avoid unnecessary fees, get paid earlier, and manage their money more efficiently. The lesson isn't never trust a fintech app. The real lesson is know who you're trusting. Because once you understand how the system works, protecting yourself becomes surprisingly simple. The first thing you should always check is who actually holds your deposits. A trustworthy fintech company should clearly tell you the name of its partner bank. If you have to dig through pages of legal documents just to figure out where your money is being held, that's not a great sign. Transparency matters. If a company wants you to trust them with your paycheck, they should have no problem telling you exactly where it's going. Second, never keep your entire emergency fund in a single financial app. Think of it like backing up your phone. You probably don't keep your only copy of your photos on one device. Your money deserves the same kind of protection. Having a second account at a traditional bank or another trusted institution gives you options if something unexpected happens. Third, don't assume the words FDIC insured tell the whole story. Instead, ask one simple question: which bank is providing that FDIC insurance? If you can't answer that question, take a few minutes to find out before depositing thousands of dollars. And finally, choose financial apps for more than just convenience. A beautiful interface, cashback rewards, or early direct deposit are all great features, but they shouldn't be the reason you trust a company with your life savings. Trust should come from understanding how the system works, because the biggest surprise during the Synapse collapse wasn't that technology failed. Technology fails all the time. The real surprise was how many people never realized there were multiple companies involved in the first place. That invisible system stayed invisible until it stopped working. And that's the biggest lesson from this story. Modern banking isn't becoming less safe, it's becoming more complex. The apps are getting simpler, but the infrastructure behind them is becoming more complex every year. The more convenient banking becomes, the more important it is to understand who's actually protecting your money. Because in finance, the biggest mistakes usually don't happen because people ignore the warning signs. They happen because people never knew the warning signs existed. So the next time you open your banking app, take a moment and ask yourself one simple question: do I actually know who's holding my money? If the answer is no, today is a good day to find out, because understanding your money is the first step toward protecting it. If you found this video helpful, share it with someone who uses a digital banking app. There's a good chance they've never been told how this system really works. And if you want to understand the hidden financial systems that quietly affect your money every single day, subscribe to Buck Logic, because every week we break down complicated financial topics into simple explanations that help you make smarter decisions with your money. Thanks for watching, and I'll see you in the next one.